That two-pronged message, as Greg said, it does center around managing client expectations. That's really what it's all about. It's not about losing a client and keeping a client. It's about what are you doing after the point of sale to actually manage their emotions and their whole behavior around the solutions you provide them. And today I'm going to focus on a unique, what I would call a product proposition at Empire Life called our Class Plus 3. That is managing their expectations about their retirement. Okay. They wanted their retirement to look very much like for example, their parents' retirement. So I'm going to get into that. Then I'm going to talk to you about, I think, a great concept at Empire that we drew up recently that can help you with an increasing interest rate environment. So what I'll do now is just give me a quick moment and I'll do some screen share with my presentation and then we'll get right into it, folks. So again, 100 years, absolutely, Greg, and we're very proud of that. And quite frankly, 100 years for any corporation in North America or anywhere around the globe is a milestone that is worth recognizing. 100 years in business does not happen by accident. And I'm very proud to say that I'm part of Empire Life that turned 100 years in January of this year. So again, as I mentioned to you, it's a two-pronged presentation. So stick around for all of the good stuff. As many of you would know on the line, when Ian Kerr does a presentation, it's not so much talking about the product, but I like to bring the product to life with sales ideas. So certainly get your pen, get your pad, and hopefully I can give you some great sales ideas, which will give you immediate traction. Again, the philosophy of this educational summit, I saw, and go make the sale. And that's what I hope I can arm you with here this afternoon. So again, in 100 years, what does that mean? Well, we started in 1923. We've been managing segregated funds for over 50 years. As a matter of fact, that first segregated fund is our Elite Equity segregated fund. It's as old as I am. So I was born October 1969. This fund was launched in November of 1969. Just unbelievable, especially from even my perspective. And I'm sure many on the line, your perspective and go, wow. That's a long time to be in the segregated fund business. So we have great capability in that space. We are amongst the top 10 life insurance companies in Canada. That should not be discounted. Now, I know that we traditionally are not in, the TV media and things of that nature, but we do rely on you, valued advisors on the line with me today. We rely on you to get that message out. But it is our job too at Empire to make sure that we arm you with the knowledge so that you can succinctly talk about Empire in a sales conversation. We have a very high rating from Dominion Bond Rating Services, which is great, and we've sustained that. You can see the financial strength. I won't bore you with saying A and issuer, et cetera, et cetera, et cetera, but these are all very high ratings as far as our ability to do what? To sustainably offer a product in the marketplace that we designed several years ago. And that is a tribute to the Class Plus 3 product that I'm going to focus on in the first half of this presentation. And again, it's a way for your clients who are looking to pensionize some of their assets. This is a fantastic opportunity and a great option in the marketplace to look at. So just to give you a quick rundown of the agenda here, we're going to talk a little bit about global investing trends, and that's just going to dovetail into the presentation proper. But it's important to note that all indices around the world are actually had double-digit growth so far this year. The only one that's lacking in the double-digit arena, it's Canada. So that whole wisdom about, 3% of the capital markets are represented by Canada, I think that that's even emphasized even more right now, given the lackluster growth rate in comparison to the other indices around the world that Canada is experiencing in 2023. So it's important to also, I'm going to give you a couple of tidbits where you can talk to your clients. And it's a great time, by the way, to give them what you would call a second opinion of their outside assets. A lot of clients are questioning, why am I in this fund or that fund or what have you? And offering a second opinion could be a great asset gathering exercise for many of your clients who would really like to have that kind of meeting. I'll get into the Class Plus 3 highlights. I'm going to say why invest with Empire Life. I'm going to talk to you a little bit about the retirement landscape and just sort of bring to life, well, why would you be talking to clients about our Class Plus 3? There has to be empirical data out there to really have you go after that particular marketplace so that you can actually make good revenue for your business and your practice. Go a little bit overview, talk to you about Class Plus 3 in action. You're going to hear how we have a riff advantage in the Class Plus 3, which I think you really want to hear. So make sure your ears are on for that. And then I'll talk a little bit about some of the additional retirement planning benefits and product support. Then I'm going to get into, again, what can you do for your clients who are clamoring in the GIC market and you're thinking, wow, I'm giving away those assets, maybe to the competitors. We do have GIC asset capabilities with most segregated fund shelves, but I know that a lot of clients are moving back to the bank when it comes to a GIC. So what can we talk to them about? What value proposition can we give your clients in talking about maybe using the money market fund? We're going to hear about liquidity advantages. We're going to also hear about a way in which we can make you more compliant while dealing with your clients' expectations through what we'd call a hyperinflationary environment coupled with a higher interest rate environment. There's a lot of rubs going on there that your clients really want some solutions around. So the global investing trend, we spoke about that, certainly could use help of advisors all around our country and trying to get your clients away from what we call the hometown bias, Canada bias. We typically are more biased towards our own stock market because we tend to have more intimate knowledge about it. I mean, let's be honest as to why that is, and also too, from a spending perspective, especially retirees, they generally want to derive the currency that they're spending from their assets. In other words, if I have my money in Canadian dollars and I'm spending Canadian dollars in retirement, I like that. I don't want to get caught behind the eight ball if the currency swing happens in 1 year, if I'm in a US or perhaps an international or global fund. So there are some real tangible reasons why clients want to be in the Canadian space, but we certainly need to educate them about the wisdom behind getting a little bit less weighty towards the Canadian stock market. And again, as I mentioned at the outset, double-digit returns in the global space. So if you had clients all in Canadian funds in 2023, they're going to really see a single-digit return. And given the MERs, et cetera, out there, it may not look that attractive. So the whole idea about putting a sleeve of the assets into a global mandate, I think there's a lot of good arguments behind doing that. And I'm not going to go down the rabbit hole and give you my thesis behind it, but I just wanted to give you a couple of talking points that you can share with your clients that I'm sure they would understand as to why you ought to put a little bit more weighting towards the global sector. We have some of the best capable minds in the portfolio management space here in North America, Ashley Mesquita, as well as Dave Mann, managing our global platforms. We also have an Empire Life Global Asset Allocation Fund, and I want to talk to you about this for one key reason. You'll notice that one of our flagship funds, the Asset Allocation Fund, that one there is a fund grade A. It actually won its category last year and was awarded that award in January of this year. But what you'll notice here, and this is the prudence behind our management when you're looking at our funds, we don't want to diversify our portfolios for the sake of diversifying because that doesn't add value to you or your clients. Clients are not going to make good money in a portfolio where you have two funds and they hold the same top 10 stocks. That is not going to serve them well. So it's nice to note that our domestic asset allocation fund actually is a very good diversifier when you couple it up with our global asset allocation fund. There is not a whole lot of overlap. As you can see, 67% Canadian, 26 foreign, 14 Canadian, 80 foreign. So that difference actually makes coupling these two together to create a very nice, what I would call a global 360-degree asset allocation story. And you can do that using our Empire Life funds. Good stuff. Want to also mention, too, with the absence of DSC, some of the nod towards, our environment and compliance, et cetera, and what we can and cannot do these days. DSC is gone, but make no mistake, folks, Empire is still offering the no-load purchase option. Ours is a 3.5% upfront gross, and then we pay a trailer starting in the 13th month. And that's what you can generate using our Class Plus 3 or also our regular GIF contracts, are 75, 75, 75, 100, and 100, 100. So that's nice. I've got some really great news near the end of the presentation. So again, do not drop off the call. Because when I start talking about our money market fund concept, you're going to also like my additional notes around the commission there. The idea too is that you can confidently book money with us today, knowing that we can provide your clients with 10 or 20% chargeback free within the first 3 years of deposit. That depends on the nature of the booking. Well, 20% would be on risk. That's amazing. So you can make the booking, and even with their withdrawals, you would not, as the advisor or the enterprise, the back office, you would not incur a chargeback. And I think that's a very strong value proposition for both the client and for you as the advisor. So you're giving them a good product, you're bringing in some upfront commission, you're allowing them to take income, which is legislated by the government, and it does not have a detrimental impact to your income. So far, so good, I hope. Okay. Now, let's shift gears a little bit, folks, because one of the realities out there is your clients are walking around in Main Street and downtowns. They're walking around and they're concerned about a couple of things. One of the big things that they're concerned about is actually having guaranteed income for life. Gone are the days where many of our parents, our grandparents, my grandfather worked for Canada Packers, 25 cents an hour, lived to 104, but he retired with a pension from Canada Packers. He was the oldest living retiree for many years before his passing at age 104. So clients and children who are your clients today, they have a backward-looking view that their parents had a nice pension, that their grandparents had a nice pension. So they're sitting there and saying, but I don't have that same environment. The world's evolving, workplace is evolving, but the one thing that is scary for me is that I don't see the presence of that guaranteed income stream coming from my company as my parents and grandparents enjoyed. The sad reality back then was that a lot of folks, unfortunately, even though they ended up getting a pension, they didn't live very long after working. That's just the way the working life was. But now, because we have the reality of a longer lifespan, longevity is one of the major risks in retirement that you have to have covered off in any product solution to your client. Longevity is a big one. And it's not even about quality of life anymore. It's just that they're living longer. The other one you have, the other three risks you have is longevity risk. I mentioned that. But also you have what we call performance risk. Sequence of return risks is another one. And the last and biggest one right now, wow, we're really wrestling with it, is what? It's inflation. Those are the four risks that your clients want to have covered off. Subsequent to this presentation, you can certainly counsel and speak to myself or your regional wholesaler at Empire on the investment side and ask them for what's called the four risks in retirement, and have them go through you online or in person, face-to-face, which would be better, and walk through that presentation. It's not only friendly for yourself as advisors to consume, but I love the way the folks at head office wrote it, where it actually resonates quite positively with your retail clients as well. And it talks about those four risks that are covered off to some degree, some smaller, larger degrees, with our Class Plus 3 product. Our Class Plus 3 product can address all four of the major retirement risks. So that's a good start. Some of the highlights I'll speak about, and I'm going to get a little bit deeper into that. We offer guaranteed income for life. Folks, if you've got a pulse, we're paying. We offer a guaranteed bonus of 4% annually. I'm going to tell you right now, for example, you're not too late. This party is still going. You can actually have the business booked up until December 31st of 2023, and your clients will still receive the full 4% annual income bonus. That is a fantastic, immediate value proposition that the client can say, wow, when I open up my statement on the second or third week of January, there's that bonus. Fantastic way to start managing their expectations. They will immediately see something that is positive emanating from their purchase of this Class Plus 3 product. Beautiful stuff. With each age, and I will tell you that we don't start paying guaranteed income until attained age 55. Just bear that in mind. Those are some of those moving parts. 4% annual bonus. Age 55 is when you can start taking that annual income. Doesn't mean you can't get into the product and start accumulating bonuses earlier than 55, but you can't trigger the guaranteed income feature until attained age 55. So bear that in mind. And coming up, you'll see a slide giving you those age brackets and the percentage payouts. So one of the things you can see here is that a unique LWA payout rates, which is the lifetime withdrawal amount, we'll get into that a little bit, for each age. Well, that's great because you see the fact is that for every year that they live, we're paying them a higher percentage. So that was what I meant about our product being able to cover off 4 of those retirement risks. This is one of the nods towards covering off some, not all. I'm not going to be liberal here, but I would say that it does cover up to some degree the inflationary pressures, which is great. We also give your clients an opportunity to make more money in the future. I love the fact that this product is not static once it's sold. It is a living and breathing value proposition and concept and product for your client. And the nice thing is that in those yearly reviews or every 3 years, you can talk about these attributes to your clients aside from that one always elephant in the room, which is the ROR, rate of return. Rate of return is something that if you're selling pure funds, that's all you've got. But when you're selling a segregated fund with layers of more protection, like the guaranteed income layer here on our Class Plus 3, well, that's gonna provide more positivity going forward. There's something going on there. And even if you have a year where the markets were weak, you can still remind the client about the other attributes of this particular product. Something that I'm very proud of, and a lot of folks do challenge me and say, Ian, those income-based resets, they don't happen. Well, they do. Now, it depends on how aggressive you want your clients to go or how conservative you set them up. But we do offer them the ability to have 80% equity in this Class Plus 3 product. Our actuaries work very hard to create that room and give us 80% equity exposure in this particular product. You'll find that some of the other products out there that say they might be a GMWB product, I'm not here to beat up on the competitors. You know who they are. They knock on your doors. Well, ask them, are you strictly fixed income? Or do you offer clients the ability to go all fixed income or up to 80% equity? I like a product that gives the client the choice. And I can tell you one thing, folks, you know as well as I do, relationships in this business, it's also about providing your clients with choice and making them feel empowered, that they're part of the conversation and they're also part of the driving force to the solution. And as you deal with older clients, they're more hands-on, because they're retiring, they got nothing to do. So they're going to want to be at the table with you. And so you want to be really sharp and astute about why it is these attributes exist. Purchase options are available. Again, I'll just simply say that we don't have DSC. We know that for sure, folks. So again, continuing along with the highlights, we have an annual automatic income resets, which is great. We also offer this in our Fast and Full investment app. Folks, if you haven't tried our online system, happy to have you run through. It's 15, 20 minutes, and you'll find that it's a very, very easy system to use. It's intuitive, so that even Ian Kerr can do it. It's really a good system, folks. It's going to save you time. That's the value proposition. It's going to save you time, and it's going to cut down on errors. There's nothing worse than getting what we call a NIGO, not in good order, because that slows down you getting paid. So I encourage you, everyone on the line, to use our Fast and Full investment app. And we also have the equivalent on our life insurance side. So great way to streamline what you do. We'll talk about some of the retirement income privileges. We do offer this in a 75-75 contract only. Want to make that very clear. Some of you might have sold our older versions where they had a 75-100 chassis as the underpinning seg fund, but we're using a 75-75. Now, some of you might say, Ian, well, why are you doing that for? I'd love to have 100% death benefit. Well, 2 reasons. A, brings down the cost, because bringing down the cost is commensurate to providing the client with what they want anyway. They don't want 100% death benefit when they're looking for guaranteed income. They just want guaranteed income. However, our 75-75, like our 75-100 and 100-100 contract, has an annual death benefit reset. By the way, I believe to date, correct me if I'm wrong, but we are the only 75-75 out there with a death benefit reset guarantee. Most of the reset guarantees, folks, in the segregated fund world are attributed to 75-100 and 100-100 contracts only. So that's nice. Client deposits $100,000 with you in our 75-75 at Empire. It goes to 134,000 over time. We lock that in, take 75% of that, and you have now given your clients 100% capital protection on their original investment. So there's a good value proposition there as well. Talked about the triennial death benefit guarantee and the income-based resets. That's going to help your clients perhaps get a higher income going forward. And isn't it nice if your clients get that at the beginning of the year? Oh, by the way, we did an internal calculation on your behalf, and you're going to get paid more this year. The good thing is that your client's never going to get paid less. Now, you work very hard to get these sales. So I love the fact that we have what's called an excess withdrawal alert service with this product specifically. And that's important because some of your clients, they might go, I don't really want to talk to so-and-so about, needing money. It's embarrassing. So, why don't we just take it from there? We'll call head office and the customer service will do it. Well, we're going to give you, the advisor, an excess withdrawal alert service so that your clients don't shoot themselves in the foot and literally lessen the benefits of the contract that they have. And I think that's fantastic because you all have better things to do with your time. So it's nice to know that Empire's got an eye on your client's behavior, perhaps without you knowing it. So that's a really good, solid piece to it. The driver, too, towards wanting this product, I think, is also this statistic. 1 and 2 expect lower standards of living in retirement. That is not good. We need to provide clients with a solution that says, you know what, I feel great about going into retirement in 5 years, 10 years, because my highly qualified IDC advisor was not so stuck on asset allocation, because there's a lot of traditional advisors out there, especially in the investment world, pure investment world. It's all about asset allocation. But in retirement, and I give a nod to Moshe Milevsky, who talks about this, it's product allocation, folks. A little bit of class plus 3, a little bit of a regular RIF, maybe some annuity so that we can cover off our overhead and never have to worry about covering off our overhead. We'll have class plus 3 and a regular RIF for our liquidity needs going forward. So really talk to your clients, because I think, too, your clients are not even used to hearing advisors talk to them about product allocation. It's something that will be stimulating to them because I don't think that conversation is being had at the table much. But if you have that conversation, it'll probably be something that's brand new to them. They'll sit up and listen to your value proposition much more then. So right now, I'm just going to pause, if I may, and take a little glass of water here. It's a little dry in these rooms. Hopefully, I've woven you a story here. You know what our global asset allocation capabilities are. I talked a little bit about why you might want to look at that area. Talked to you and set the table and said, what about those folks you have as clients today that have a rear view of their parents and grandparents having a beautiful pension uninterrupted? It was beautiful. So this is the product that can really help fulfill their need that a lot of clients are screaming for, quite frankly. And it's really up to us together to bring them that message, because clients, they have no idea what class plus 3 is. One of the things that I will say that is for supporting materials on our websites, and we'll certainly provide that to you in my summary, a link towards everything that is class plus 3 at Empire Life, including YouTube videos. I think that they're among some of the most important aspects of that link that I'm going to get you to, because that gives you an opportunity to educate your clients about the product before you even meet with them. So it's nice to give them sort of a little bit of a tidbit without giving away the farm, because you don't want to do that. You don't want to be behind the 8 ball when you get there. But it gives them enough information to be dangerous. But that's it. You're going to have to go to that meeting. You're going to have to fill in all the details. And then ultimately, again, as is the theme today, make the sale. So we know we've got an aging population. I'm not gonna harp on that. An increasing female aging population. They live longer. So this product was really, really good for those folks. Some female households where, you know what, there's a widow or divorce or what have you. There's a single income happening there, and they want a little bit more security going forward. That's certainly a demographic that you would want to talk about this product to. And we also know that some of the traditional sources, government sources, OAS, CPP, etc., they're under pressure. I'm not going to be alarmist here, folks, and say, well, you better not rely on them, because that was kind of the messaging maybe a few years back. but the government knows how to pivot to make sure that it's properly funded. But you don't know. They might expand it and say, sorry, retirement is now 70. They may change some of the means testing. We don't know that. So there are moving parts in the government sources that we can address by having the client have some of their assets in a class plus 3 product. Workplace pension coverage. Gee whiz, I mentioned that at the outset. I mean, come on. Defined contribution, big time. Defined benefit, gone by the way of the dodo bird. And so now we have clients, your clients at their workplace, taking on more of the burden of the volatility of the markets. Back in the day with a traditional pension, oh, the markets are down. Oh, that's okay. Companies guarantee me this much. I'm not too concerned. That's a little bit different nowadays when you have many of your clients with a defined contribution plan. And traditional retirement investments are just not working. Like I mentioned to you before, Canada is in single-digit returns, YTD for 2023 compared to the rest of the global indices, which are in double-digit returns. So clients in Canada especially have, I guess they've gotten used to lower yields, not so many high returns. But you know what? You may get high returns, but now all of a sudden we're inviting volatility. And in retirement, clients can't really handle the volatility. We don't want clients to suffer massive volatility swings in their values of their accounts, because we don't want your clients going from eating steak to eating hamburger. Now, hey, listen, I love nothing better than a juicy burger on a barbecue. But in retirement, I want to decide whether I want the burger or the steak. I'm sure you too, for your clients, you want them to have that ability to decide and not relegate them to saying we're going south, but we're going south to Buffalo, New York from Ontario. That's not going to work. When you say you want to go south, you want to go to Florida, maybe you want to go to Mexico. So these are the real things that are floating through your clients' minds. We put it together with all those numbers, but it's not the numbers that they're concerned about. They're concerned about, so what's the value prop? Do I have to wake up worried, or do I have to wake up and go, what a great day it is today? And thanks to my IDC Win Advisor. So retirement planning risk, I mentioned them, didn't I, folks? So we're just going to skip over this very quickly, but I talked about longevity risk, inflation risk, market risk, and sequence of returns risk. These are all risks that'll never go away, folks. So the question is that if your clients are concerned about these risks, what product in our marketplace today can actually address these? Now, again, as I mentioned to you, I'm not saying that our product can address these issues in its entirety, but it still can take away some of the inflationary pressures. It can take away the longevity risk. On our Class Plus 3 product, if your investments went down to zero, we still have to continue to pay you that guaranteed income for life. Now, don't buy into that, because I don't see the market going down to zero, but go back to 2008 when if you're in the TSX, you took a 35% haircut. That means you took a 35% haircut in your RIF income, or you had to take 35% more to keep that standard of living up. But by taking 35% more out of that asset, what have you done? The asset may not last as long. So now you've got the longevity risk coming into play. So these are the types of things that you and I can talk about. Your local wholesaler at Empire, we can talk about that. And really put together a very compelling story that the client can go, you know what? You hit all bases, and this makes sense. Now let's make the sale. So Class Plus 3, let's just quickly overview. I did give you some of the tidbits here. We talked about the annual bonus, 4%. Again, folks, you get in by December 31st, and we'll still give you a full 4% year's bonus. This is beautiful stuff. Your clients are going to have good news when they open up their statement in January, regardless of what the markets do. They're going to see the 4% bonus being credited to their account. I mentioned about the three-year resets. I'm not going to harp on that anymore. The income phase. This is the beautiful thing, folks. You know, if you went and sent me an email after this call and said, Ian, can you do a quote for me? I can get the quote to you, and guess what that quote contains? That quote contains exactly what your clients want to leave your office with. Certainty. If you have a regular RIF, you cannot provide that certainty that a RIF in our Class Plus 3 can. They can literally walk out of your office today and go, you see this, honey? Wow, this is exactly what we're going to get. Now, forget about what the market's doing today or when we're retired, but Isn't it nice to know that this product's actually going to give us this, and we can rely on this, and we can plan around this, and we can plan around this today? That certainty is what clients are looking for, folks. Some of you on the line will challenge me and my colleagues and say, oh, but it's too expensive. This is too expensive. I always believe that the quality remains long after the price is forgotten. How many of you have your suit and tie on, or you have a pair of shoes on you bought 3 years ago? Do you remember what it cost? No, but you know you look great in that suit or that tie or those shoes, don't you? Because they provide value long after you forgot about the price. And that's exactly what clients are. We know that. The mentality we have, as long as that's serving me well, I'm not concerned about what I paid along the journey. Very, very important stuff. I talked about the annual automatic income resets. Again, that's going to help increase the income. And again, we do that recalculation on your behalf and the client's behalf and provide them with notification on an annual basis. You either went up or you stayed the same. Income-based resets, again, automatically every 3 years. That's one of the pieces I mentioned that helps stem the tide of inflation. And also our unique payout percentages that increase with each year the client ages. That too is going to help stem the inflationary pressures. So some of the building blocks that you should be aware of, and we've already been talking about some of this stuff. I know it's 1:35 right now, so I want to be very, very aware of the time here. We have what's called an income base, and that income base is take a check. You put $100,000 in. That's your deposit minus withdrawals, okay, plus your income-based resets and income-based bonuses, and that's that 4% bonus I'm talking about, the annual bonus. Now, I want to give you a bit of a footnote because these are some of the details you should be writing down. With respect to the 4% bonus, I failed to mention earlier, but you're allowed a maximum of 20 years of that bonus. Doesn't mean you have to take income in the 20th year. It's just that we're going to allow you to do a deferral bonus for up to 20 years. You could start collecting the income in year 25, but we're not going to be bonusing you from years 20 to 25. So just bear that in mind. And that's a good way. If your clients get in earlier, they can take full advantage of the deferral bonus before they have to trigger income at age 71, or again, as late as 72, technically, with a RIF here in Canada. So bear that in mind. The income-based resets, again, that happens on the 3rd anniversary of the contract, and it is on the anniversary of the contract. It doesn't happen January 1st for everybody. When you open up the contract, if you opened it up today, September the 27th, that's when, in 3 years now, on September 27th, we're going to go in and do some income-based resets. So super stuff. And hopefully all of you are getting a good flavor from this. This is a set it and forget it kind of investment product solution for your client. And I don't mean that you don't have to manage it and monitor it, but quite frankly, all of the moving parts that I'm speaking of, guess what? We're doing it internally for you. So I love this set it and forget it mentality. You can go on to do what you do best. And this is actually something that should resonate very highly with advisors who are what we call life-centric on the line with us this afternoon. Very good product for that, folks. You don't have to micromanage this product, especially if you're looking at, you're wrestling with large cases, IFA cases, things of that nature. I believe our product allows you to continue to do what you do best. And I'll talk about the bonus base as well. So that's used to actually calculate income-based bonus at the end of the year. That's simple as that. So the base adjusts due to these factors. All of the deposits, because clients can put periodic deposits in. As a matter of fact, dollar cost averaging out of a money market fund might sound attractive. Well, that's coming up. Minus excess withdrawals. And again, we have that monitoring service, so we want to be careful there. But that's a great thing. Okay. So we have that ability to do and control the bonus base. And again, we're monitoring in case your clients, want to shoot themselves in the foot. We don't want that. The income-based bonus I mentioned is 4%. That's notional, by the way, folks. For anyone on the line that's not quite clear, that is not a compounding 4%. So it's a good opportunity for me to clarify that. It is simple interest. And some of your clients too. This is one of the objections I've been getting in the field recently with the higher interest rate environment. Well, Ian, I can get a 5%. I can get 5.25%. You can today. But if we see lower interest rate environment come back, and your client's been in this product for 10 years, 15 years, and they're accumulating bonuses, Does anybody on the line have a certainty that the GICs are gonna garner a 5% or 5% plus rate of return or yield in 10 years? But remember, we are contractually obligated, folks. This is a big difference. We are contractually obligated to make sure you get that 4% bonus. And it's not going to change due to the whims of the Bank of Canada saying we're going to raise interest rates or we're going to lower interest rates today. That 4%, that's going to be there. And if the prime goes to 2.5% in 5 years, your clients have a 20-year time horizon. Now what? Now the 4% looks pretty good, even though it's not even compound. It still looks good. So be wary of that and maybe use that as your objection response. If your clients say 4%, I can get 5.25% at the bank. But how long can you get 5.25% at the bank? Just to give a little bit of a graphic display of what we're talking about here, the X's basically mean no income reset. Remember, I mentioned every 3 years. So here, 3 year, 3 year, 3 year. These are the anniversaries: year 3, 6, and 9. And these are the legend here. Your income based, the deposits, the income-based bonuses, 4%, and your income-based resets when the markets and the activity in the funds present themselves to do that. So this is a nice slide, and I'm going to encourage everyone on the line. I mean, one of the things that you probably heard me say over the years, this is great stuff to share here in this forum, but it really comes to life when you share it at the point of sale with your client. And I'm more than happy to have this, slide. If you say, Ian, I saw slide 20, email me. I'll get it laminated. Give me a mailing address, because these things are great and I'm presenting wonderful things, but you're going to bring life to this when you share it with your client. I mentioned about those payout rates rather. And as you can see at age 55, remember that's the first and earliest date that you can take the income, 2.85%. You can see how that percentage increases as the clients age each year. We get to a maximum of 5.25% at age 80. So a very nice value proposition. Again, this is one of the aspects of the contract that helps stem some of that erosive effects of inflation that clients are certainly experiencing today. I talked to you again about the automatic income resets. I'm not going to kill you with that part there. Just go on. I talked to you about it. And so that's the way it works. The automatic income reset calculation, as you can see here, is in what I call something in play here. So you can actually see it in action. And literally that's how it works, right? We take that 154,000 and change and we times it by the income percentage at age 75. And if I can, age 75 here, 4.9%. So that 4.9%, we internally do that calculation. The client's now getting $7,549 instead of $7,513. Sorry, folks. So there you can see the dynamics in action there, which again is driving value to your clients, and hopefully that stems off the cost of a hamburger going through the roof, right? That little extra money. One of the realities out there that you're wrestling with as an advisor, 56% of workers retire earlier than planned. And folks, they're not retiring earlier because they're flush with money. They're retiring earlier because of illnesses, and they're just sometime through those illnesses, they have an inability to perform their work. And that is a reality as well. You're not going to really see these 56% of workers retired earlier than planned. It's usually not because they're flush with a whole lot of money and they can call it a day. So bear that in mind. Some of the need for flexibility and how this class plus 3 solve it, right? So timing of retirement is out of your control. Well, you can start getting retirement income as early as age 55, which is different than the government programs, correct? So you can use this as bridge income, if you will, for some of your clients, which is great. Here it says want to work past age 65. Okay, great. So it'll reward you for taking income later. You're going to have a higher payout percentage at 68 as opposed to age 65. The opportunity to take contract work. This is a very real dynamic. There's a lot of folks that I talk to lately, and I'm sure you do. I really don't want to retire. What is this concept of retirement? People don't necessarily want to retire. They want to do something else. They want to follow their passion, and they also want to make money at it. So there's a lot of folks that will come back in. They get relief from their duties at a company, and then that same industry brings them back in on a contract or a consultative level, right? Well, then, wait a minute, though. They're paying me really well. This product is beautiful because you can stop and start the income with the non-registered sleeves. Once you start the age 71 with the RIFs, the government wants their pound of flesh. But think about the opportunity and planning opportunities around telling clients that in a non-registered Class Plus situation, your clients can turn the taps on and turn them off according to their tax situation and their work-life profile. There's a lot of folks that just want to work, and they're in their 60s, right? Oh, I retired, but they still want to work. Work is very satisfying to many of us. And so I think the new reality out there in retirement is that people are not going to necessarily stop working. They're just going to work differently. So let's talk about Class Plus 3 in action here. Let's take an income later scenario here. I'm going to speed up just a tad, folks, because what I would really love is the opportunity to speak about these scenarios one-on-one. Because when I speak to you or my colleagues speak to you one-on-one, we can get very granular with that exact client. Are they taking income later? In this case, are they deferring income, etc.? So the accumulation phase is where they're at. They want to grow some savings before retirement, insulates them from market declines. Class Plus 3 will deliver income with the potential to grow with annual 4% interest, income bonus. We talked about that. And also the resets on the product as well. So clients may be pleasantly surprised that through resets, they're actually going to have a higher death benefit guarantee for their heirs, and they're also going to derive more income. Beautiful stuff. Income later scenario, Sarah's going to invest $250,000 and at age 50. And so she's going to defer taking income. She's eligible for 15 years. Because remember, so of the 4% annual bonus and resets. Now, she wants to begin income at age 65. So, folks, I don't want you to think I've contradicted myself, because that piece there that says eligible for 15 years, well, she could take it all the way to 20 years of bonus. I want to be very clear there. But we're saying 15 years because she has a desire to start taking that income at age 65. So that's the specifics of this case. But remember, you can defer for up to 20 years. So the income base has grown with all of those bonuses accumulated over 15 years. She went from 250,000 to 537 and change. That means the LWA, her lifetime withdrawal amount, will be a minimum of $21,497. Folks, this scenario, remember I mentioned to you earlier with our illustration system, you can have your clients walk out with this certainty. In the unprotected world out there, and I'm not poo-pooing it at all, I'm just simply stating this. For clients who want pensionized dynamics around their assets, pure mutual fund, you cannot have your clients walk out with that. You say, hang in there, look at the 10-year number, take a look at the index chart, we'll be okay. But how many clients go, I thought you said I was going to be okay when you told me in 1998 I'd be okay. It's 2008 and I took a 35% haircut. So I don't know what you're talking about, but your 10-year index numbers. But you have to remember too, folks, you got to be specific to your client's 10-year time horizons, not the stock market's 10-year time horizons. So an income now scenario, well, this one's really easy, right? So bottom line is you put money in, we're going to take a look at the payout percentages. We're going to take a look at your client's age, and they're off to the races the following month. Simple as that. The key thing is what you did see on previous slides. Again, we start income at age 55, and we can go all the way to 80 plus. And that's where at age 80, they got a 5.25 payout. This is really good stuff here, folks. Really good stuff. So an income now scenario, dovetailing from that last slide, well, he retires at 65. He's got $400,000. So he's going to get $16,000 annually. Simple as that. The payout percentage is 4% at age 65. There's your $16,000. Great stuff. He can never have his income go down. It can only go up on a go-forward basis. Semi-retired, talk a little bit quickly about that. The transition stage, again, there might be less income coming in. Well, why don't I start that income at age 55? And again, in a non-registered portfolio, you really can give your clients the ability that they're driving the bus. And these days, retirees want to feel like they are driving a part of the bus. They want you to come to them with the solution, but they want to drive the bus, right? We know that. And so a lot of these attributes that I've gone over so far this afternoon really tackle those pieces there and that mentality with your clients, okay? I'm going to just skip over this particular piece here, folks. I'm going to talk a little bit about the additional retirement benefits. I mentioned a couple of them already, and I'm not going to be redundant. 80% equity exposure. This makes the chance of the income-based bonuses and the actual income-based resets rather, makes it reality. That's a great thing. We can go all the way from conservative, go all the way to aggressive. We are known to be conservative in our investment approach, folks. We tend to grow, we tend to preserve clients' capital first, and then we have a mandate to grow it second. But, looking closer under our hood, we do have mandates that do have a growth aspect to it, big time. But even then, we want to manage all of those assets in a prudent manner and not have your clients with too many surprises. So sometimes I do hear, oh, Ian, you guys aren't doing, relatively speaking. Yeah, but in down markets, we preserve more capital than most houses out there. Some tax and estate benefits as well. Tax advantages of non-registered investments. In a class plus 3 scenario, it's amazing how much return of capital we're able to push out, thus making it very tax efficient to clients who are taking a guaranteed income from a non-registered sleeve of assets. Some of the estate planning benefits, well, named beneficiary, which is terrific. We heard a little bit about that from Don Hart as well at the VP conference recently. And it is important to make sure that you actually construct these particular contracts. You got to construct them properly, folks. And if you ever have any question about who should be annuitant, successor annuitant, beneficiary, who should be owner, joint owner, please lean on me. And again, your respective Empire investment wholesaler in your region, because you get to do this once, folks. All right. And once we do it once, we do it right, good to go. Set it and forget it. The RIF advantage. This is a massive one, and I'm going to get right to the details here. What we're doing is simple. We are going to pay you the higher of the two. As you know, the RIF minimum that you have to take is derived from the year-end asset value of your account times the payout percentage that the government prescribes through their RIFs. So we do too. That's why we have, you'll see this in the illustration. We have two side-by-side coupled together to show that. So we're gonna pay the higher of the two at all times. And even if we do, it would not be considered an excess withdrawal, folks. This is wonderful for all of your clients who just want to take the RIF minimum. A fantastic solution for that. This just gives you a little bit of a graphic depiction of that. And again, if you want that laminated, give me a holler. Successor annuitant and creditor protection. Again, I mentioned that a little bit, but you should be aware too that, you've got a couple of tests when it comes to creditor protection. We can talk about that more. I'm running short of time here. But bear in mind that you can't just have a client willy-nilly get into a segregated fund contract, whether it's our base contracts or class plus 3, and all of a sudden say, oh, did I tell you that a creditor's coming after me? They've been coming after me for 3 months. Well, creditor protection is off. The general asset test out there, folks, is that your advisors, rather your clients, need to get into a seg fund 12 months or more before they've ever had any constructive notice of creditors coming after them. So that's a big one there. Naming a successor annuitant is really good because what this does for this contract, it continues to breathe life into the family because we can actually have that continue to a widowed spouse on the death of the annuitant. We do a recalculation based on the widow's age. So bear that in mind. But that happens seamlessly so that the income can continue to them. What a nice legacy to leave behind. So just going to go really quickly over here. I'm going to talk to you, just whip through a couple of the marketing pieces. But the best thing to do, we are your marketing pieces, your wholesalers, your respective wholesalers in your area. You want to learn more about this product and how to bring it to life and add value to your clients, give us a holler. Now I want to switch gears and talk a little bit about our money market fund solution. Folks, we've had a lot of pressure out there in the marketplace to find client solutions that actually can stem, again, the high interest rate environment, et cetera. Well, I'm going to just put it in a GIC. I'm getting 5%. It's amazing how many clients forget about the erosive effects of inflation. The reason why the banks are paying 5% is because they're lending their money out at a much higher rate than that. So they don't even take into consider inflation because hamburger is now, X dollars more per pound. They just say, I'm getting 5% at the bank. It's like this number. It's like this magic number. So I would just really strongly suggest for all you on the line, always talk about the interest rate environments in the GIC world relative to inflation. That's going to help educate your clients about the wisdom behind being in a GIC. But the other thing I want to talk about is our Empire Life. What have we done to actually match, or rather not match, but recognize the client mentality today with a high interest rate environment over the last year in 2022. So what we're doing is We're targeting a 4.5% annualized rate of return, but actually, that's actually updated as of this slide, compilation time. It's 4.7% now, folks. But the story gets better. So what are we doing? We're waiving management fees. And I often hear in the industry, oh, you just guys, you kill us with the fees, etc. But here we are doing a really good thing here in a sort of a hyper environment, a hyper interest rate, hyperinflation environment. It's nice to see that Empire is able to pivot to provide you and your clients with some value proposition. So this is a good news scenario so far. So how did we get to the 4.5? Like I said to you, it's very simple. We're now at 4.7% because of the recent increase in the prime rate. It's actually 4.7% now, folks. And again, we just simply reduced the MER. That's been the key driver to that. And we constantly monitor it. You should note that nothing in the fund can have a maturity longer than 12 months. So it's a very liquid fund as well. This is just a quick comparison of some of our competitors. And as you can see, that's our new targeted rate. Some of these numbers have changed, folks. So I'm certainly not here to be disparaging. I'm simply sharing this as information. This is an informational slide. You make up your mind. But it's not so much the numbers here, is it, folks? Not a big difference here. And again, these numbers have been adjusted upward recently due to that increase in the interest rate. But it's about this. What is it? And the question is this. My thesis is this. If you have money locked away for a particular term, and then the markets turn around, how do you get your clients out of that and get them into the market? And even if you can, how many days of delay in the market activity are you incurring by doing those machinations behind the scenes to get that money into the market? Do you have to give up all of the money in a high interest savings account or a daily interest a GIF? Do you have to give up? Okay, like that's the question. Do you have to give up liquidity? So a lot of those things, you have to take all the money out or you leave it all in until the maturity date comes. With a money market fund, there is no maturity date. That's a beautiful thing. And you don't have any term that you're locked to. So you don't have to worry about your clients incurring a market value adjustment because they feel they're losing out on some fantastic returns in the market. So this is what I love about our money market fund concept. It's a great way for you to track and retain existing clients rather, so that they don't go to other places where they get GICs. Okay, this is a great way for you to keep it under your purview and to continue to generate revenue. And again, the bigger fence you build around your client's wallet, the more control you're going to have over their outcomes. That's a fact. We had to do our homework and make sure that we can provide with a competitive rate that's comparable to the outside world there, if you will. And again, this is a nice safe haven that you can switch in and out of once they're placed in our Empire funds according to the markets. Dollar cost averaging would be a good thing, wouldn't it, folks? Okay. This is just a little quick snippet of the eligible contracts. Again, contact myself or your local wholesaler. We'll talk to you all about this stuff. I really want to give you just a big gist here of what's going on here. The other thing I just want to mention quickly before I finish is that even with the money market fund, you get paid. So this actually goes towards your gift growth bonus. We've still continued that all the way to December 29th of this year. This is super stuff. We actually have the data. If you've done business with Empire, we can actually pull the data that says you're on track for this particular growth bonus. So bear that in mind as you do your bookings for the balance of the year. And I just talked to you about the growth bonus and some of the eligibility. Again, the key thing is that I like is that you get paid in January, which is a nice bonus when you're starting your year. The other eligibility pieces, again, we can talk about that one-on-one. So when they're ready to pull the trigger out of the money market fund, you can pivot today, not pivot in 6 days or 4 business days because of the machinations behind the scenes. And we can get rid of all of that stuff. We want to provide them with some perspective, of course, but that perspective says that this is the same thing as you going to the market. You go to the grocery store and you buy tuna. You got $8 a month to spend on tuna. Tuna's $4 a can, you get 2 cans. Tuna's on sale for $2, you get 4 cans. And that's the idea behind what I'm starting to talk about, which is dollar cost averaging. Dollar cost averaging out of our money market fund can help you deal with the volatility that's out there. And we know scientifically, if you have a dollar cost averaging strategy into a very volatile fund, Dollar cost averaging into it brings down the volatility meter considerably. That's going to give you and your clients much more reason to sleep at night, even though you might be in a more aggressive mandate because you need maybe a little extra return in the long run. So again, your clients are ready. Dollar cost averaging strategy. That's going to bring investment discipline. I was speaking with a compliance officer recently, and I was talking about this, and he loves this idea because it keeps you compliant, folks. The client cannot say to you, "Hey, Greg, why did you put me into the managed market on September the 27th?" Because today, on January the 1st, we're reviewing it. I'm down 10%. If you dollar cost average into that, your clients will not ever be able to hold you up and say, "What are you, a market timer?" No, no, no. This is a long-term strategy. Remember, we talked about dollar cost averaging. So it takes away market timing, folks. And again, that can make your practice a lot more compliant than saying, "Oh, I pulled the trigger and took the money out of and maybe incurred or didn't incur a market value adjustment." But in that other product where it's all or nothing, I decided to take it out that day and put it into the market. I better have some really good notes to justify why I took my client's money out in one fell swoop day one and put it all into the market day one. And then that last piece I mentioned to you about the tuna scenario. We know all about the tuna scenario. Folks, there's one other note that I want to make. I got about 2 minutes left. With our money market fund, we are paying no load upfront commission. So that means you can generate a gross 3.5%. Don't get into the wrestling match about what your share is, but we are going to pay a gross 3.5% to you for putting money in the money market fund. I believe we have one other competitor in our space that's doing the same, so kudos to them as well. But this is a great way for you to make a lot more than about, I don't know, average 25 basis points on some of those GICs and high interest savings accounts. What are you deriving for your book of business and putting the client in a scenario where you're going to have to market time them out? So I think I've described for you at the tail end of this particular presentation a prudent approach where you can enhance the revenue to your book of business by doing the right thing for the client. Folks, thank you so much for your time this afternoon. It's always a pleasure to present to IDC, and I want to thank everyone for making Empire your choice this afternoon.